I've always said I'd stand ready to do more as the situation evolves, particularly with energy prices, where the price cap will most likely go up again in the autumn.
They present the same kind of risks that we have known for centuries in connection with bank runs.
I don't think it's a Lehman moment, obviously not the prettiest of episodes, but we get one to two of those per year.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Here's what's coming up on today's programme. Your top stories: going green, stocks and futures post modest gains. Jerome Powell again pushes back on speculation of more aggressive hikes. Crypto panic subsides, Bitcoin jumps, but Terra's problems remain as its blockchain is halted, restarted and halted again. Plus, UK Chancellor Rishi Sunak pledges more help to tackle the cost of living crisis and says the Brexit settlement in Northern Ireland is causing harm. More from our interview this hour. Let's check in on these markets then. We talked about the modest upside that we are seeing, a relief rally arguably around the comments from Jay Powell that 75 basis points is not being actively considered. The first time he's spoken publicly then since that surprise to the upside with the CPI print out of the US coming in at 8.3%. So 50 basis points from June and July still baked in by these markets, but reassessing that commentary and the views around 75 basis points. Of course, the markets as well this week shifting to concerns increasingly about recession. Citi saying that when it comes to US equities, they are exiting now bubble territory and they're calling for a shift to value. In terms of what's happening again across the markets here in Europe this Friday, of course, 1 hour into the session, gains across a benchmark of 1%. More pronounced here in the UK, and again, we're going to bring you that interview with Rishi Sunak, the pressure on the UK Chancellor around the cost of living crisis as the BOE flags stagflation, possibly recession as well. Solid gains in France, up more than 1%. The DAX is up by 0.9%. So green across this picture here in Europe. The geopolitics still front and centre. G7 meeting, of course, and we know that the Europeans are trying to get this deal across the line when it comes to restricting access of Russian oil into their markets. More volatility in the S&P 500 then pushed the index within spitting distance of a 20% drop. It's down about 17% year to date, a decline that puts markets on the covers, of course, of newspapers and holds ominous meaning for the economy. Down as much as 1.9% Thursday and 30 points from a bear market. Before a last hour rally, the benchmark appears destined to decrease for a sixth straight week. Growing certainty that the Federal Reserve's efforts to halt inflation will send the economy into a recession as lopped nearly $10 trillion off equity values in 18 weeks. We are joined now by Claudia Panseri, Head of Equity Strategies and Tactical Asset Allocation at UBS Global Wealth Management. Claudia, how do you weigh up what we've seen across the markets this week, the gyrations, whether it's within crypto, FX, or indeed the bond space?
Good morning, Tom. Yeah, the week has been pretty volatile, but we are also in a period of time which is quite difficult to read. So I think investors are trying to calculate the impact of less excess liquidity and fiscal tightening on different asset classes. So volatility has been big across tech, before on unprofitable tech, on cryptocurrency recently, but also on the Forex side, you see that volatility is pretty high, and the bond market as well. So clearly, one element I will say the market is driven by risk, geopolitical risk, rate environment, but also recession risk, which seems to me is start to be priced in some part of the equity market.
That's interesting. Whereabouts within equities is that recession risk being priced now? Is it fully priced? How much further is there to go?
I think a mild recession is priced at the global level. The thing I like to look is, for instance, the relative performance of cyclical versus defensive, and the performance of equity, 6-month performance, 1-year performance versus ISM or other lead indicator like export, Korean export, Asian lead indicator, and so on. And when you look the performance, for instance, of cyclical versus defensive, we are now pricing an ISM which is below 50. So that will be a mild recession, not a big recession. Valuation have come down quite a lot, essentially driven down by nominal rates, but real rates as well. The movement we had over the last 2 weeks on real rates has been massive. So I when you look sector and countries, countries like Japan, emerging market, and also countries like UK are relatively cheap. So we like UK, for instance, which is a market where valuation are really cheap, but also is let's say a market where you find a nice breakdown between commodity-driven sector and defensive sector like healthcare and consumer staple.
We have a redhead crossing the terminal right now, Claudia, around Samsung. Its decision apparently to hike chip-making prices by up to 20%, a 20% increase in chip-making prices from Samsung. So just a reminder of the inflationary impacts that we're seeing across corporates and across the global economy. What does this tell you as an example of where inflation and our views on inflation should start to become in terms of the grounding? As we start to see it ebb off, do we need to now start to think about inflation remaining at a relatively high level even as it eases?
Yeah, I think inflation will stay at high level, will probably stay above central bank target until the end of the year. We clearly see that there is a switch between inflation linked to consumer goods to inflation linked to services. You mentioned semiconductor and chips, but also when you look at the last CPI report, we clearly see an increase in inflation on services. What could change? Probably this tightening monetary policy. One is now putting some pressure on inflation expectations, so that is positive. For sure, a market slowdown, which is also increasing tightening liquidity condition, and in addition, less consumer spending, that will have an impact on inflation. Inflation will stay anyway above target, at least for this year, but the trend is what matters the most, is people realize that month on month, inflation is coming down. They will be less concerned about over-tightening and risk of recession.
OK, the trend of inflation as it lowers, importance, of course, for the way that consumers think about price increases. Claudia Panseri from UBS Global Wealth Management staying with us. Thank you for those insights. And coming up, crypto chaos sparked by the Terra collapse seems to have calmed, at least for now. We'll dive into the crypto story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, the implosion of the Terra USD stablecoin on Wednesday sparked widespread panic in the crypto space after entering a death spiral. But 24 hours later, things have calmed down significantly. Tether, the biggest stablecoin, has kept its peg against the dollar, and Bitcoin is now trading at around 30,191 to be precise, having fallen below $26,000 earlier in the week. Janet Yellen, meanwhile, has given the US government's most forceful response yet to the Terra meltdown. The Treasury Secretary said that the crypto stablecoin's woes underscore the risks associated with the asset class.
I wouldn't characterize it at this scale as a real threat to financial stability, but they're growing very rapidly, and they present the same kind of risks that we have known for centuries in connection with bank runs.
OK, an intervention there by Janet Yellen. Joining us now is Emily Nicol, our crypto reporter in London, who's been kept busy this week, no doubt. Emily, what is the latest then on stablecoins? It seemed like they were quite shaken up then after the Terra flop, but now they appear, at least some, Tether, to have weathered this storm.
Yeah, so most stable coins, if you look at the market today, are pretty stable, as is in the name. Most of the largest ones anyway are circling around their dollar peg. Tether dropped briefly below 96 cents yesterday, and that was one that caused the most ruffles because it's supposed to be the most reliable one in the crypto ecosystem. However, it has managed to recover to about 99 cents, and that's close enough to be considered back to the dollar. So.
And how's the wider crypto ecosystem holding up at this point?
It's a sea of green this morning. Bitcoin's up, as you said, and as are all the others. I think there was probably a bit of a knock-on effect from the Tether sell-off on Wednesday and throughout the week. But mostly people have rushed to the cryptocurrencies they know now, which are, those Bitcoin, Ethereum, all the ones you know the names of. So everything's looking rosy again.
Everything is looking rosy, at least for now. Let's see how long it lasts.
Yeah,
Emily Nicole, our
now.
crypto reporter in London. Yeah, that important caveat. Thank you for those insights. OK, let's get the Bloomberg First Word News now with Leanne Gerrans. Leanne.
Tom, good morning. European natural gas prices have spiked and some shipments from Russia were disrupted, with Germany accusing Moscow of weaponizing energy supply. Meanwhile, some EU nations are saying it may be time to delay a Russian oil ban so they can proceed with the rest of a proposed sanctions package that says Hungary continues to impose that embargo. Now, Russia's ambassador to the EU has warned Moscow will likely step up defences along its border with Finland if the Nordic nation does join NATO. This comes after Finland's president and prime minister issued a joint statement on applying for membership of the defence pact. Local media reports that a Swedish bid could come as soon as Monday. North Korea has revealed what it calls the explosive spread of an unknown fever after confirming one death from COVID-19 and ordering a nationwide lockdown. According to the nation's news agency, 350,000 cases have now been identified, a day after it first admitted that coronavirus was actually in the country. Sri Lanka has a new prime minister, with veteran lawmaker Ranil Wickremesinghe returning to the role for a sixth time. He has been named premier after several days of violent protests. The appointment is seen as an attempt to restore credibility as the government negotiates a bailout package with the IMF. And scientists have released the first image of the supermassive black hole at the centre of the Milky Way. Sagittarius A is about 27,000 light years away from Earth and is considered supermassive because its mass is more than 4 million times that of the Earth's sun. It's only the second time visual evidence of a black hole has actually ever been captured. Global news 24 hours a day on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Tom.
OK, supermassive is a new adjective for me. Leanne, thank you very much indeed. UBS Global Wealth Management is advising investors to continue adjusting for a world of elevated inflation and rising rates. They see value stocks outperforming and maintain a preference for energy firms. Claudia Panseri from UBS Global Wealth Management is still with us. Claudia, thanks for sticking around. I'm not going to ask for your precise views on the crypto space. I know that's not an area that you engage in. But in terms of what it indicates about liquidity conditions, financial conditions across these markets, and whether we need to brace for further shocks.
Yeah, I think as long as volatility will remain high in the bond market space and real rate will be moving higher, the value segment and value sector, but also value countries still look appealing in terms of correlation to rate, in terms of valuation. So they will be less under pressure versus pure third stock and still expensive stock. The way we look at value is probably different from the one people usually know. We tend to look into sector which are and stocks which are cheaply valued but also with a quality bias. So we look for profitable stock which high free cash flow. That is the place where people should be investing today.
What about mega cap tech? I mean, the valuations have come down significantly. Is there an opportunity for investors who haven't had exposure to get into some of these big names at this point?
I think people need to be very selective because you have tech sector, within the tech sector and growth segment, you have different name and you have mega caps, but you also have mid and small cap. What is really important to watch is this company are still margin which are resilient or not. Overall valuation is coming down, but is not probably cheap enough to call for a trough. Once again, some companies are still trading at 13 times and maybe margin will be probably not much under pressure, but we may see margin peaking. So clearly for companies with high valuation, negative correlated to real rate, with margin at risk, there is still downside risk to come in the next month.
Is there an underpricing of the energy risks, particularly when it comes to oil, when you look at the energy complex, Claudia?
It's still underpriced. It's still underpriced because there is a high correlation between the earnings momentum and energy. And earnings momentum has been improving since last year, but we didn't catch up yet in terms of prices. So the prices are lagging not on energy itself, the underlying, but is also lagging the earnings momentum of the sector itself. Free cash flow, valuation is cheap. So I think the energy sector is quite an interesting one, and also is an edge in case the geopolitical risk is not ending. So clearly energy plus a wide value segment exposure, that will be something we continue to push in the weeks to come.
How do you factor the China demand shock into that call?
The China shock, we put in our selection not only pure value, we add also some defensive segment on the market, which are cheap. We compare the valuation, for instance, of healthcare relative to real estate or utilities, and healthcare look pretty cheap. And within healthcare and pharmaceutical, at the global level, you have value stocks. So on the top of traditional value names or sector like financial, energy, and commodities, we also add the healthcare and some consumer staple name where valuation is not stretched. So clearly, we have exposure to value with, I would say, a quality overlay.
How do the concerns about recession in Europe play into your regional weighting, Claudia? What is your preference at this point?
Yeah, on the Eurozone, we are neutral today. Valuation come down quite a lot. There are some risks, despite Q1 was pretty strong, that earning revision will be on the downside. So within the Europe, we prefer UK, where the sector breakdown is still to value and I will say defensive as well. If we look into UK, for instance, you have this exposure to energy, and we like energy, exposure to commodities related like mining, metals, and so on. We like it. And also exposure to defensive sector like healthcare and consumer staple. So clearly we have, with the UK, a bias which is quality defensive, and so should be more resilient than other regions within Europe to rising rate, higher commodity price, and volatility.
Excellent. Claudia, thanks so much for coming on and joining us this Friday with your thoughts. Claudia Panseri, Head of Equity Strategies and Tactical Asset Allocation at UBS Global Wealth Management, likes what's happening in the UK, at least exposure to UK equities. Echoing a call that we heard from Barclays about an hour ago. Coming up, Elon Musk seeks to scrap his Tesla margin loan with new Twitter funding. Going to hope to reduce his risk there. More on that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, Elon Musk is in talks to raise enough equity and preferred financing for his proposed buyout of Twitter to eliminate the need for any margin loan linked to his Tesla shares. Let's get more then on all of this with Bloomberg's Laura Wright. Laura, talk us about the share price reaction, the market reaction to the detail that we're getting out from Elon Musk when it comes to the changing financing situation.
Well, Tesla up a healthy 3.8% in the pre-market, but worth noting the stock is down almost 30% over the last month, in part because Elon Musk has offloaded nearly 10 million Tesla shares to fund his purchase of the social media company, which sent really a negative signal to the pre-existing shareholders, implying he valued Twitter more than the electric vehicle maker. Twitter trading $45 in the pre-market. There's still a wide gap between Musk's bid price of $54.20. And that gap suggests the market think there's still a risk the deal may fall apart, albeit it would be a costly risk as the party that walks away will be charged $1 billion at an exit fee. So in terms of the state of play with financing, it's really threefold. $13 billion in loans against Twitter. Now, that figure has not changed, but the other two have. $6.25 billion in margin loans against Musk's Tesla shares. Formerly, that figure was double, but we learned in an SEC filing last Thursday that Musk had been able to secure an extra $7 billion in financing from investors, and that meant he could increase his equity commitment to $27.25 billion from where it previously stood at $21 billion. But in a report from Bloomberg, we learned that his advisors over at Morgan Stanley, they're trying to bring this margin loan down to zero because it mitigates the risks of Tesla's share price falling, which would make that loan obsolete.
Yeah, that was a concern, wasn't it, when he initially got this financing together? So that's some details on the money. What about what's happening within Twitter itself, the changes at play within that company?
Cost-cutting, financial prudence, that's the latest state of play. Twitter will be freezing hiring, and yesterday we learned in a memo from Twitter's CEO Parag Agrawal that any new hires are going to be on hold. They're going to be intentional with hiring and their costs. There have already been a number of notable departures, the head of revenue and the head of consumer, and employees have been told to focus on shorter-term projects in the meantime, but it adds to an environment of uncertainty, Tom.
Bloomberg's Laura Wright and the latest when it comes to Twitter. Coming up, UK Chancellor Rishi Sunak speaking to Bloomberg on Brexit and the cost of living crisis. We've got that interview next. This is Bloomberg. Welcome back. Here are your top stories. Going green, stocks and futures post modest gains. Jerome Powell again pushes back on speculation of more aggressive hikes. Crypto panic subsides, Bitcoin jumps, but Terra's problems remain as its blockchain is halted, restarted and then halted again. Plus, UK Chancellor Rishi Sunak pledges more help to tackle the cost of living crisis and says the Brexit settlement in Northern Ireland is causing harm. More from our interview later this hour, in the next few minutes, in fact. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Let's get to that interview then with the UK's Chancellor of the Exchequer, who says, again, as we mentioned in the headlines, that Brexit is an issue, of course, when it comes to that protocol. And, of course, we're waiting to hear what the decision is from the UK government. Rishi Sunak is calling on the European Union to be more flexible. We've heard that one before in negotiations on the Northern Ireland Protocol. He sat down with Bloomberg's Stephanie Flanders.
Our preference is to have, and always has been, to have a negotiated settlement with our European friends and partners, and no decision has been taken about what the future direction might be. And with regard to your second question, look, of course, that's my job, to provide the Prime Minister and the government with analysis on policy regarding the economy. You'd expect me to do that on everything, and of course we do. And we're constantly monitoring everything that's going on and analysing that as we go.
But we understand that you could get legislation next week to make it possible to tear up the protocol, and that seems to be what the Foreign Secretary is supporting. Are you lobbying hard on behalf of the economy to prevent that?
I think it's important people know that no decision has been taken. Our preference has always been to have a negotiated settlement. I know the Foreign Secretary continues to engage with her counterparts in Europe about how we can find resolution to some of the very real challenges that the protocol is causing, not least being a barrier to resuming power sharing in Northern Ireland, which is something that we all want to see.
Well, and you said that it's the Treasury's job to analyse these things. When the protocol was signed, it was very clear that these checks were going to happen, that there would be this kind of impediment to trade. So that's something that's no surprise at all.
I think when it comes to the protocol, we have to recognise that there's a unique situation in Northern Ireland, and everyone acknowledged that at the time, and it required a degree of flexibility and a constructive attitude on all sides to recognise the particular circumstances of Northern Ireland to come up with a solution that would work. Now, the protocol. But
this one doesn't work.
Well, exactly, and I think what we need to see is a degree of flexibility and a constructive attitude to try and resolve some practical problems on the ground. And I'm hopeful that continued dialogue and negotiation can resolve the situation and result in a negotiated outcome.
But just we'll get on in a minute. But when you're weighing up the impact on the economy as a Chancellor, it seems clear that you would be pushing for the continuation of the protocol rather than throwing all of our trade relationship into uncertainty.
Well, it's important to me, as it is important to the government, that we also protect the Good Friday Agreement, that we resume power sharing in Northern Ireland, that we make sure that Northern Ireland's place in the Union, in the United Kingdom, is secure. And it's clear that the protocol, as it's currently operating, is is causing harm on all those things, and that's why we remain committed to trying to find a resolution on that. It's a serious situation, and that's something that across government we all feel.
Our economists estimate that the cost of living squeeze altogether is going to cost the average family well over £2,100 this year. You've got, as a result, real disposable income falling by 4%. We're also expecting to see the economy shrink in the second and fourth quarter. We've already saw today it started to shrink in March. I mean, do you look back now and wish that you had got more ahead of this crisis in the spring statement, rather than yet again having to rush out some emergency medicine under pressure from the rest of the government?
No, I think it's important that the policy remains responsive to the situation that we're seeing. And in the spring and in February, we had a sense of what was happening. In particular, we had clarity on energy prices because the price cap was increased in April by about £700. And we announced in advance of that the support that was going to accompany that increase. And it's worth about £350 for a typical household. It's about half the increase. And then on top of that...
But overall, I've just said it's 2,000, so that doesn't feel responsive.
Well, that's just one aspect of what we're doing. And if you look what's happening in a few weeks' time, for example, there's a very significant tax cut coming in for 30 million people in work that's worth £6 billion.
Significant tax rise.
Well, it means that most people in work, the vast majority, 70% of them, will see a net tax cut. In fact, it's worth £330. The combination of our fuel duty freeze and fuel duty tax cut, the largest ever cut to fuel duty, that's worth another £100 for a typical family. In the autumn, in advance, we improved the generosity of our universal credit system to help people as they move into work from welfare. That particularly supports low-income families. And again, that's worth £1,000 for a typical person benefiting. The national living wage has just gone up a few weeks ago. Again, that's worth about £1,000 a year to someone working full-time on the national living wage. So you put all these things together, there's quite a lot of support in place. But I've always said I'd stand ready to do more as the situation evolves, particularly with energy prices, where the price cap will most likely go up again in the autumn. And I'm focused now on, I'm out and about across the country, listening to people, hearing what's on their mind, what they're worried about, to make sure that we can get our policy right. And that's the thing that I'm focused on now doing.
UK Chancellor of the Exchequer, Rishi Sunak, speaking to Bloomberg there. And of course, the focus on the cost of living crisis. We'll get analysis now with Bloomberg's UK economy reporter Lizzie Burden. Lizzie, we heard the Chancellor there saying that he didn't raise additional funding and didn't pass on additional money to the poorest households because of an IT problem. At least he said that in the broader interview. Does that sound, it's going to sound like that's a bit of an excuse from the Chancellor?
Yeah, blaming this decades-old IT system for why he's not done more to help the poorest households via benefits. What's happened is the benefits rose 3.1% at a time when inflation was running at 7%, because, of course, benefits are tied to inflation from the September figure the year before. Now, lobby groups had said, why not smooth the rise? Because when we get a record rise in benefits the next April, inflation's expected to have fallen, and by splitting the difference, that would have helped 4.5 million people. But Rishi Sunak blaming the legacy benefits IT issues when he could use universal credit, as he did in the pandemic. Yes, it will raise some eyebrows, especially after he was able to pull off the furlough scheme at the height of the pandemic without a precedent.
Without a precedent, exactly. He could turn it off and turn it on again and see if that reboots the system, the IT system within Whitehall. When it comes to the politics then and Northern Ireland, there was a significance around his comments and his alignment, apparently, with the Prime Minister on the question of the protocol.
Yes, there had been reports of a rift between numbers 10 and 11 on how to deal with Northern Ireland. The Prime Minister has emphasised that the protocol is harming trade and stability in the region, although he signed up for the deal. And that's even worse now because the pro-UK Democratic Unionist Party doesn't want to join a government with the nationalist Sinn Féin until something's done on the protocol. Sunak reportedly had been arguing the economic case for not ripping up the protocol. But as you saw in that interview with Stephanie Flanders, he does seem to land on the side of prioritising restoring power sharing in the region. So effectively risking his economic credibility to be loyal to his boss.
And the EU have made it clear that they may consider retaliation in the form of trade if this is effectively axed by the UK government.
Yes, and what worse time for a trade war when you've got a cost of living crisis in the UK.
Lizzie Burden, thank you very much indeed. Across all things UK when it comes to the economy, as ever. Some lines crossing when it comes to the Chinese economy. This is important for the fiscal impulse that you're seeing in the world's second largest economy, of course, as it grapples with COVID-19 and the lockdowns in cities like Shanghai, partial lockdowns in Beijing. You're getting new yuan loads for the month of April coming in well below the estimates, and aggregate financing as well, also slipping significantly below the estimates. So this is important in terms of that financial impulse, that fiscal impulse, I should say, within China, and whether or not this is going to force and compel officials to step up spending to support that battered economy in China. So some lines are there on aggregate financing and new yuan loans, both coming in below the estimates. OK, coming up, as the EU's proposed Russian oil ban falters, G7 foreign ministers vow to break Moscow's blockade of grain in Ukrainian ports. We have the latest from the G7 summit. That's in Germany. This is Bloomberg.
It is a word that central banks and political leaders are looking to avoid: recession. And investors and executives say it is a real risk, especially in Europe.
If Ukraine gets worse, I would assume that Europe's going to go into recession. It may take a couple of quarters, but I would assume that.
It does look like the recession risk is very high.
There is a good probability for that. If I have to really guess, I would say 50-50, you know.
I think that we're pretty close to recession through this year.
The danger of a recession has loomed into view as the Eurozone economy faces strong headwinds. Persistent high inflation, the ongoing war in Ukraine, and the worsening energy crisis tied to it.
The impact of energy on the European economy will be substantial.
The ECB says economic figures currently don't suggest the war in Ukraine has pushed the euro area into recession. But officials have acknowledged that, while growth risks have increased substantially.
The war in Ukraine is severely affecting the euro area economy and has significantly increased uncertainty.
Central bank officials are still determined to press on with normalising monetary policy, with many holding out the possibility of a first interest rate increase in July. The central bank remains optimistic it can deliver an exit from crisis-era stimulus to cool record inflation. There are doubts, though, that the central bank can avoid a recession, or that dreaded stagflation, which has little growth with high inflation. With Europe so close to the war, countries supporting Ukraine and sanctioning Russia damage their own economies as well. Germany has already significantly cut its growth forecast for this year, saying it is at risk of shrinking nearly 2% if the war escalates and could be tipped into recession by further sanction packages against Russia. European factories are signalling distress amid record prices and a stubborn supply squeeze, aggravated by strict lockdowns in China. Europe is facing pressures from all sides, leaving investors on watch for whether they will push an already fragile economy into recession.
Bloomberg's Caroline Hyde reporting there. Let's stay on the war in Ukraine then. Some EU nations are saying it may be time to delay a Russian oil ban so they can proceed with the rest of a proposed sanctions package. That as Hungary continues to oppose the energy embargo. For more, we go to our European correspondent, Maria Tadeu, who is at today's G7 meeting. Maria, how likely is it then that EU officials will delay oil within this sanctions package?
Well, what is very likely is that this is an embarrassment for the European Union, and it's just not a good look for the European institutions. What we have now, and this is a story overnight by Bloomberg News, is that there are now divisions in terms of should Europe wait to get the full deal, including that oil embargo, potentially look into a summit at the end of the month for Viktor Orban to finally concede to this, or actually just approve whatever it can get over the finish line from this sixth package of sanctions. You know, it's not a good look, Tom, because if you remember, almost a week ago, the G7, that includes, of course, the French and the Germans, the two EU countries that participate in it alongside Italy, they already agreed that they would end their reliance on Russian oil. And here we are in a situation where the EU 27, the overall picture, they're not able to get it through the finish line. So it is clearly not a good look for European institutions. But again, it also sparks a debate debate that we get oftentimes in the situation about whether or not this overall majority, this EU 27 decision-making process is actually working or not, or potentially whether the best way to deal with this would be a qualified majority, simple majority of a coalition of the willing. But for the time being, it does seem that this has hit a major roadblock.
Yeah, indeed. Some would argue that Hungary is holding the rest of the Europeans to ransom on this issue. The G7, though, that's why you're on the ground in Germany for us. They're focusing on the collective response. What is likely to be top of the agenda for them?
Yeah, and you know, Tom, we just heard from the foreign ministers here from those G7 countries. The Ukrainian foreign minister, Kuleba, is also here, and also the Moldovan foreign minister, too, are all participating here. Now, the word that gets repeated is unity, standing united against this Russian aggression, helping Ukraine achieve victory in the Russian war. We also hear that the Europeans may also pledge to increase the amount of money they facilitate for weapons. But the other big issue here, Tom, very related and connected to the situation in Ukraine, has to do with food. Now, they say that, of course, Ukraine is a major agricultural hub. This is a huge producer, but of course, the country is at war. They're not going to be able to harvest as they normally do, and this could lead to a major food crisis, particularly when it comes to developing nations. And all of this already, Tom, in a spiral of food inflation could lead to a serious hunger crisis by the end of the year, according to the ministers that are meeting here today.
OK, European correspondent Maria today on the ground following the twists and turns of this G7 summit, this meeting, this push for uniformity when it comes to the messaging on Ukraine. Let's get to the Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Tom, good morning. SoftBank shares have jumped in Tokyo on hope for further buybacks. That is despite the group reporting a record $20 billion annual loss at its Vision Fund unit. The world's largest tech fund has been grappling with write-downs and a global stock rout. Now, Treasury Secretary Janet Yellen has given the US government's most forceful response yet to the Terra USD meltdown, saying the stablecoin's woes underscore the risks of crypto. She called for new regulations and confirmed the Treasury was working on a report about the issue.
I wouldn't characterize it at this scale as a real threat to financial stability, but they're growing very rapidly, and they present the same kind of risks that we have known for centuries in connection with bank runs.
And Twitter has announced a hiring freeze, reflecting the company's state of uncertainty while it awaits Elon Musk's $44 billion takeover. Sources tell Bloomberg the company will not hire new employees and may withdraw some offers already made as it looks to trim costs. And that's your Bloomberg Business Flash. Tom.
Leanne, thank you. Coming up, a crypto chainsaw massacre this week has bloodied crypto exchanges. That story is next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Just checking bonds as you have a move out of sovereigns, reversing some of the action that we've seen this week. Yields higher on BTPs, on German bunds, and the US 10-year as well. Currently at 290, so 6-point move up there in terms of the yield on the benchmark US 10-year, and a 9 basis point move higher for the Italian BTPs, 280. Risk on across the equity markets, gains of more than 1%. So reworking some of the views on the back of Jay Powell, suggesting that 75 basis points still not on the table, still not being actively considered, according to the head of the Fed. Now, talking of financial conditions, cryptocurrencies only seem to work when prices are going up. On the way down, nothing seems to work the way it should, a common trait to history's many Ponzi schemes. Let's caveat that by saying that this is the view from the latest Bloomberg opinion column by Lionel Laurent in the wake of this week's crypto chaos triggered by the collapse of the prominent stablecoin Terra USD, to give it its accurate name. Joining us to talk about this crypto outlook then is Bloomberg opinion contributor Lionel Laurent. Lionel, some punchy words there then on what we've been seeing within these crypto markets. You've talked about a chainsaw massacre. Where do things stand now? There's a bit of relief in these markets. Did you get it wrong?
So you are right. We're in this sort of stabilization phase after a kind of massive drawdown of more than 50% in Bitcoin. I do think this is different, though. I don't quite buy the idea that this is just another kind of sell-off and then we move on. We have a kind of a tsunami of problems here that are battering all markets, but which hurt crypto in particular, which is rising interest rates, which is not good for an asset that yields nothing and is based on a lot of kind of tech, distant tech moonshots. And also the threat of economic pain and recession, a kind of stagflation situation. These are both very bad for speculative bets like Bitcoin. And so I think what's going to happen now is you are going to see money stay on the sidelines. You're not going to see a massive rush back in. I do think people will lose their jobs. Maybe there'll be some smart crypto developers or blockchain experts for other companies and banks to pick up. And deals will slow down. So I think it's a question of, is this a crypto winter or crypto ice age? But I really do not think this is just the switch being flicked back on right away.
To take the counter side of this, Leon, do we need to distinguish between the frothier parts of this ecosystem and the more established parts, the bits of the ecosystem, the blockchain, Bitcoin, Ether, that are backed by institutional funds? That's where there is some rigidity. That's where you can get some opportunity now.
Well, you're right to point to institutional funds as the winners in this. I think that hedge funds in particular and smart traders have had a whale of a time. Arbitraging between all of the exchanges out there, arbitraging between coins. Someone has made a lot of money, basically, from the death of Luna and Terra, the depegging of stable coins, the fall of Bitcoin. I'm not saying there aren't winners. I'm just saying that the kind of narrative where this is a populist uprising and everyone's going to win, provided you get in quick and stay on and stay in Bitcoin and crypto, just isn't working. If you look at all the coins you mentioned, Bitcoin, Ether, Dogecoin, Ripple, doesn't matter what the underlying story or technology is, they're all very different. They all have suffered a massive hit over the past year. So I think when things go wrong in crypto, as I say, nothing seems to work and everyone has to rush for the exits.
What are the contagion risks, do you think?
Well, I don't think that they are as big as they could be. For example, I think talk of a hit to financial stability, as Janet Yellen said, it's somewhat contained. But look, we have a lot of companies that went public that are linked to crypto during the retail frenzy of the pandemic. We just objectively have more listed companies on the stock market that have taken a hit, and consumers as well, less money, feeling poor, feeling the wealth effect. They'll be turned off all types of markets. I think this is a real risk.
Read the column, read it online, read it on the terminal. Lionel Laurent, Bloomberg opinion columnist, thank you for your insights on all things crypto this morning. Bloomberg Surveillance Early Edition continues in the next hour with none other than Matt Miller, Kailey Leinz in New York, and Anna Edwards here in London. Stay with us. This is Bloomberg.
I've always said I'd stand ready to do more as the situation evolves, particularly with energy prices, where the price cap will most likely go up again in the autumn.
They present the same kind of risks that we have known for centuries in connection with bank runs.
I don't think it's a Lehman moment, obviously not the prettiest of episodes, but we get one to two of those per year.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, May 13th. Our top stories today. European stocks and U.S. futures are higher today. Fed Chair Jerome Powell is pushing back on speculation the central bank will go for steeper interest rate hikes. Panic is subsiding in the cryptocurrency market. Bitcoin and other alternative coins stage a rally. And a warning from Moscow, Russia will likely boost defences along its border with Finland if the Finns go ahead with plans to join NATO. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. Good morning to you, Kailey. So after all of that crypto chaos that we saw earlier on this week, we're back to buying stocks and selling bonds.
Yeah, absolutely. I have to admit I was a little nervous coming into Friday the 13th in a market like this one, Anna, but so far it actually seems things are okay this morning. They certainly were more than okay if you're long equity markets in Asia overnight. The MSCI Asia Pacific Index was higher by about 1.6%. Lots of benchmarks in the green. We're in positive territory by more than that, including the Hang Seng Tech Index, which of course houses the large cap Chinese technology stocks. They were up about 4.5%, so a nice relief rally there. I would note that the other area you're seeing some of that risk on sentiment playing out is in the FX market, and that the Japanese yen is the big laggard in Asian currencies. Well, one of the outperformers is the South Korean won. It had actually plunged to a decade low in the Thursday session. A lot of concern there about China's COVID-0 policy, what that means for growth, and as a result, what that would mean for South Korean exports. But some relief coming into the currency today, stronger against the dollar by about 0.4%, trading around 1,283. Finally, though, I would note that you were seeing some of that bid into the bond market still evident in the Asia Pacific overnight, really across a number of countries, including in New Zealand, where that 5-year yield came in about 9 basis points to just about 3.4%. But obviously a little bit of a different story when it comes to treasuries this morning, Matt.
Good morning, Kailey. I'm excited. It's a risk on Friday. I know it's Friday the 13th, as you point out, but look, people are buying stocks, selling bonds, selling the dollar, buying Bitcoin. So everything's looking pretty good right now. We're up 1% on the S&P futures after not such a bad down day yesterday. I think we were off like 0.1% in the cash trade. The U.S. 10-year yield rising, but as I will show you later, it's been an incredible drop in yields, not just in the U.S., but in the U.K., in Germany, and around the world. Bloomberg Dollar Index coming off a high earlier this morning. It was up just a few hours ago, but now it's down as investors kind of untuck their shirts and roll up their sleeves and go in to buy risk assets. Bitcoin is one of those risk assets. Now, it had an incredible drop, and this has caused real problems not only in cryptocurrencies, but as Kriti Gupta is going to tell us in just a little bit, there's been a little bit of waves of contagion into the plain vanilla market as well. Now we see a rebound back above 30,000. It's a key level that people are watching very closely. The question is, can it hold? Anna, what do you see in Europe?
Matt Miller with his Friday feeling energy. Well, something's got the European markets excited as well this morning, and they're certainly rebounding from some of the losses that we saw yesterday. So we're factoring in here the turn that we saw in US markets later in the day. They made their way back to flat, and European markets turning and making their way back into positive territory. So up by 1.4% on the CAC 40, so certainly some positivity coming through in the French market. In terms of the sectors on the move, we've got bank stocks doing well. In fact, most sectors in Europe are in positive territory, but the bank sector, I can show you that one, the bank sector doing well. In particular, Polish banks actually seem to be doing well this morning. They had confirmation of the central bank governor over in Poland getting another term. Euro-yen in focus once again. This was really on the move yesterday. We saw euro weakness against the dollar, but also against the yen yesterday. And today we see a little bit of a rebound in keeping with that risk appetite, boosting the single currency. The Italian 10-year yield, I put that one in here. We could have had all kinds of other European sovereign debt assets, though, because we are seeing buying of stocks and selling of bonds and those yields going higher. And that seems to be the theme across, well, this is the Italian 10-year, but certainly at the longer end of other European government sovereign curves, we are seeing that. UCB is a pharmaceutical company based in Brussels, in Belgium. That stock down by 11%. Bad news from the FDA on an approval they were waiting for one of their drugs, not going down well with the markets. Onto Russian assets, we've had another day of confirmation that flows from Russia through Ukraine, that's gas flows, are not running as they normally would, and that was something that the markets were watching for. Just in terms of sentiment, we will continue to watch the Russian ruble as well, which has been really gaining, as broken as this market is and as incomplete as this market is with so many capital controls in place right now. Interesting to see that we've got the Russian ruble strengthening to levels that we haven't seen since March 2020, Kailey.
Wow, more than 2 years. All right, Anna, we are so close to the weekend, but there is still quite a lot going on in the day ahead we have to get through first, including some U.S. economic data. The University of Michigan Consumer Sentiment Survey is due out at 10 a.m. Wall Street time. Plus, we'll get more Fed speak. We'll hear from Neil Kashkari as well as Loretta Mester. President Biden will be meeting with King Abdullah of Jordan at the White House. They are expected to discuss Jerusalem tensions as well as other regional issues. And finally, President Emmanuel Macron's first term officially ends at midnight. Traditionally, that's the deadline for the president to name a new prime minister, who then forms the new government, Matt.
All right, so we'll be watching all of that very closely. More importantly, the volatility, at least for this moment, the volatility in the markets has been insane to watch. The S&P 500, the benchmark, on the brink of a bear market yesterday before a final hour rally. Kriti Gupta, our markets correspondent, joins us now to talk about this and its relationship to crypto and crypto's relationship to this. It's kind of a vicious cycle.
Well, all that fun stuff, Matt. We have to talk about this bear market first. Let's start there because that's really the main part that's going to impact more and more consumers or more and more people who are retiring on this for their pension funds. But if you actually look at what the S&P 500 has done year to date, we're actually looking at about an 18% decline. It did hit that bear market territory just briefly yesterday in intraday trading, but look at what it's doing. You do see these kind of big increases when you had, this was when you saw a 10% drop. You did see this bear market rally. The question here is, do you see that again? And at least when it comes to futures trading, you sort of are, but keep in mind some of the other factors that are at play here. The currency strength is going to be a big one because one of the big reasons for this massive, monstrous tech rally that we saw in the last 2 years has been the foreign bid into U.S. assets, and specifically that tech exposure. The way to do that, though, is to get that, to buy dollars to get into the U.S. stock market. But what happens if the dollar gets stronger and stronger and stronger, while purchasing power for some of these other major economies actually weakens more and more? And that's really creates a little bit of a hurdle to get into the S&P 500. So really keep an eye on that. This morning, though, the dollar a little bit weaker, as you pointed out just a little bit earlier. But still, the question here is, as you start to see some of this purchasing power weaken across the entire world in the face of a hawkish Federal Reserve, is the stock market still that attractive?
Okay, so that's the broad macro picture then. Kriti, good morning to you. What stood out to you in the last 24 hours as we continue to watch cryptos, but from meltdown to recovery in some cases, obviously not Terra USD, which is still in trouble, but certainly things looking calmer on the Tether and the Bitcoin front?
Yes, it is certainly looking calmer. Good morning, Anna. There is a theme here, and if you'll let me put my macro hat on for a second, there is a theme here when it comes to valuations. If you look at the S&P 500, the narrative isn't about operating margins anymore. It's about valuations and what exactly the S&P 500, even some of these major tech companies, are actually worth. If you look at the Terra drama, it's a similar story. Sure, there was perhaps a bank run on Luna, which is what Terra kind of has that coexisting dynamic with, but at the end of the day, it comes down to what is it actually valued at. And when you ask that question, cryptocurrencies tend to come under the spotlight, and that's going to be a big part of what you see in terms of the rebound. How much do people actually want to diversify, and is it worth diversifying in the face of that kind of volatility?
It's a story that we were all going to continue to follow, Matt and I, especially on Bloomberg Crypto, Tuesdays, 1 p.m. Eastern. Don't forget. Thank you so much to Bloomberg's Kriti Gupta. Now let's head over to Washington, D.C., where Jerome Powell has officially won Senate confirmation for his second term as Fed chair with an overwhelmingly bipartisan vote. Meanwhile, on the foreign policy front, the Senate was forced to postpone final passage of a $40 billion Ukraine aid package after Republican Senator Rand Paul refused to allow the vote unless language he demanded was added. Emily Wilkins, Bloomberg government reporter, joins us now from D.C. Emily, what kind of blowback is Senator Paul getting for this?
Well, he's actually going up not only against Democrats, but really Republicans here. You saw both Majority Leader Chuck Schumer as well as Minority Leader Mitch McConnell take the floor yesterday, urge that this bill pass. It still is going to get done, Kailey. Let's be clear about that. This is on track to pass around mid next week, but timing is of the essence here. Right now, the Biden administration says they've got a deadline of May 19th, where they're going to no longer have any sort of funding to pull down to help Ukraine unless Congress replenishes that funding. And so that's why timing is really of the essence here. Leaders were very much hoping to get this bill done this week, but because you've seen just one senator, just Rand Paul, hold it up, it is going to take additional time. And you did hear this week a lot of pleas for this process to move quickly. You heard Defense Secretary Lloyd Austin say that this funding that the U.S. has been providing to Ukraine has really made a difference in the war, and that we're at a point where really any sort of gap in that funding and in that ability to provide aid is going to make things difficult on the ground in Ukraine.
He's like the honey badger, Rand Paul. He doesn't care. Emily Wilkins of Bloomberg Government in Washington, thanks very much for that. Now, Russia's ambassador to the EU has warned Moscow will likely step up defenses along its border with Finland if the Nordic nation joins NATO. That seems fairly obvious. This after Finland's president and prime minister issued a joint statement on applying for membership to the defense pact. Local media reports that a Swedish bid could come as soon as Monday as well. For more, we're joined by European correspondent Maria Tadeo, who is in Germany at the G7 meeting. And clearly, Maria, if we start to build up defenses on one side of the border, Russia's going to build up defenses on the other side of the border.
Yeah, that's what Russia says they want to do. But, Matt, if you look at the map and the combat engaged troops that they have already in Ukraine, frankly, for a lot of European officials, it's hard to believe how Russia could, to some extent, be ready to win or potentially even fight a war on two fronts, considering just how much they've struggled to do this in Ukraine. Now, a lot of this, the Finnish authorities say that they were expecting. This is a type of language, bravado, that they would expect for the Kremlin. But nonetheless, this application is going to go ahead, potentially. You mentioned it to Sweden next week. And Matt, the idea is that from now until the end of June, there's a big NATO summit expected in Madrid that would finally make this application official, and the two countries would join NATO. Now, on the interim, and this is important to note, both Finland and Sweden, if they confirm this, will ask for security guarantees from their European partners if anything were to happen. We already heard from the UK saying they would be very keen and glad to do this. I expect pretty much everyone else on NATO to also say the same, to help them on the interim between the application and, of course, that formal acceptance from the rest of the NATO alliance.
Yeah, we've certainly heard those commitments from the UK government already, Maria, as you point out. On the subject of oil, then, let's get back to the European attempts to get an oil embargo against Russian oil in place, Maria. And this has faltered because of Hungarian resistance. And it looks as if it might actually be parked for a while. We might not see progress on this for a while.
Yeah, and it's not a good look for the European Union. And at this point, yes, Hungary is holding up this final deal. It does seem that Viktor Orban not only wants the cash, not only wants the concessions, but also the political victory to come with it. And the idea is that potentially there will be a European leaders summit to try to get this thing finally over the finish line. But it is not a good look for the EU institutions. A few days ago, the G7 already put out a communique saying we're going to pull out of oil. That includes Italy, Germany, and France. But of course, the EU27 is not able to get its deal over the finish line. Of course, it's not good for the credibility of the institutions. And again, it brings up this perennial debate, the unanimity, the 27 agreed on something. It's just not good when it comes to fast reaction. Perhaps a simple majority is the way to go in the future.
Yeah, it's a lot of parties to have to get in line. Thank you so much to Bloomberg's Maria Tadeo in Germany. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. There is one in particular I am focused on this morning, and that would be Robinhood. The shares are up nearly 20% in early hours after the billionaire founder and CEO of the FTX crypto exchange, Sam Bankman-Fried, disclosed a 7.6% stake in the online brokerage. Now that is the equivalent of about 56.3 million shares. He paid a little more than $648 million for that stake, but actually as of yesterday's close, it was only worth about $482 million because Robinhood has continued to see declines. But obviously with the gain we're seeing today, a lot of that loss could be made up. Why is this important for Robinhood? Because crypto is increasingly important for Robinhood. It made up about 18% of their total net revenue in the first quarter, and Vlad Tenev, the CEO and founder of the company, has said that it is one of the top areas of growth going forward. But clearly any kind of boost is something that Robinhood kind of desperately needs right now, because since its public debut back in July of last year, that stock is down 77%. Of course, part of that is just the broader technology sell-off we have seen, Anna, but the other part of it is concern that retail trading boom, the meme stock frenzy that Robinhood benefited from more than a year ago, has started to fade in a big way, Anna.
Yeah, absolutely. Not so many rockets to the moon, perhaps. Dan Boardman-Weston joins us shortly. We'll talk to him about these markets then. CEO and CIO of BRI Wealth Management. Kailey was mentioning the tech sell-off. Is that creating any opportunities yet for Dan? Plus, how the global diamond trade is fracturing under the weight of Russia sanctions. Read more about that story in today's Big Take. That's NI Big Take. That's the function to use on your terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. We are simulcast on both Bloomberg Radio and Bloomberg Television. I'm Matt Miller here in New York with Kailey Leinz, Anna Edwards out in London. Now, today, we're seeing kind of a reversal of most of the trends that we saw this week, and treasuries are no exception. Today, investors are letting go of the debt, and as a result, the yield is rising. But what we've seen this week is really a huge decline. In fact, as investors piled up treasuries this week, we saw the biggest decline in yields that we've seen since March of 2020. Now, this has a lot of implications, of course. It's a massive, massive market. So Dana Al-Battashi joins us, Bloomberg managing editor for credit right now, to talk about how we've seen the move in govies, and this has happened in England, in Germany, and around the world, affect the rest of the credit market. Dana?
Hi, good morning. So yeah, you know what? You're basically seeing markets reacting quite violently to data that quite scared them about economic growth, but also the prospect of recession. At the end of the day, you know, the concern is whether or not central banks will continue raising rates in an environment where people fear that economic growth won't be able to sustain itself. And economic data out of the UK, of course, this week showed that that risk is really real.
And Dana, what does that mean for credit markets? I know that's where you spend a lot of your time focused on, and we've already seen quite a repricing of credit as a result of this tighter rate environment.
Well, it's an absolute nightmare for those bond arrangers that have to sell the debt for their clients. I mean, at the end of the day, you're supposed to give your clients the best deal possible, but when you've got rates that are going up one day and down the next, you're really in a market where you have to guess whether or not that day is going to be a good one. So you're in this like news cycle. You have to move based on what's happening in the news, and that's not necessarily how bond syndication works. So people are having to really deal with this volatility that they're not used to, or at least they haven't been used to for a long time. And that basically means that you've got some weeks where we have a lot of sales, and we've got some weeks where we have absolutely no sales. And that's not good for liquidity overall.
Dana, there's a lot of conversation about whether or not we've seen full capitulation in the equity market. Is there any signal that that has come for credit yet?
That's really hard to judge. You know, we came into this year knowing that this is going to be a year where people were actually going to look at the fundamentals of every single company. So it's very hard to say whether or not we have reached that point or not. At the end of the day, you know, we haven't seen the sort of defaults that we were worried about, but that doesn't mean that they aren't going to come. So we don't really know if we've reached it. To be honest, this could blow out way more, or it can actually contract way more. And that's one of the reasons why people are quite worried. There's a lot of volatility here. We can go either way, and it depends on what central banks will do next.
Dana, thank you very much. Dana Al-Battashi joining us there with analysis of these markets. And for more market analysis, check out MLIV Go. That's the function to use on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. For the first time, Chinese officials have set a timeline for ending one of the longest and most punishing lockdowns during the pandemic. Shanghai says it plans to stamp out community spread of the coronavirus and start opening the city back up by May 20th. The lockdown has been in place almost 6 weeks. It's a sign of the uncertainty at Twitter while the company waits for Elon Musk's $44 billion takeover. Twitter has announced a hiring freeze and other cost-cutting efforts. Meanwhile, two of the company's top leaders, the head of consumer product and the revenue chief, say they were asked to leave. And of course, as we continue to monitor this Twitter Elon Musk saga, Anna, we understand that he is trying to raise enough equity and preferred financing so that he doesn't have to rely on that Tesla margin loan.
Yeah, absolutely. Trying to sort of de-link it from Tesla then, I suppose, Matt. And also interesting that the deal spread actually widening on Twitter, as if the longer this takes to get done, the more the market is just asking itself if it really will happen.
Yeah, it's very interesting stuff. But I have to say, I kind of lost interest already in the whole Tesla Twitter takeover. Is that wrong of me?
Very short attention span,
yes,
clearly.
True.
It's all onto crypto this
like
week.
A goldfish.
Yeah, crypto is definitely Matt's thing this week. Right, Dan Boardman-Weston, somebody with a memory longer than a week. We'll talk to him next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. European stocks and US futures are higher today. Fed Chair Jerome Powell is pushing back on speculation the central bank will go for steeper interest rate hikes. Panic is subsiding in the cryptocurrency market following the implosion of the Terra USD stablecoin. Bitcoin and other alternative tokens staged a rally. The largest stablecoin used in crypto markets, that's Tether, recovered from an earlier mini crash. And a warning from Moscow. Russia will likely boost defences along its border with Finland if the Finns go ahead with plans to join NATO. Meanwhile, the US Senate was forced to postpone final passage of a $40 billion Ukraine aid package after Republican Senator Rand Paul refused to allow the vote. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Interesting to see that geopolitics playing out, Matt, and whether we're seeing a breakdown perhaps in the unanimity, cross-partisan support we've seen in the US and the cross-border support we've seen in Europe for all kinds of tough measures against Russia. Back in the markets, though, none of that really sticking, and we're rebounding from earlier crypto chaos. That's reading across into stocks as well.
Yeah, for sure. Risk assets are fascinating today. I also want to point out, you and I were talking earlier about wheat. Now, that is just massive, maybe even more important than energy markets globally. So we'll continue to watch those contracts. But in terms of less important things like S&P futures, we're up today. There is risk on feel in this market because investors are willing to let go of the debt that they're holding. You can see the 10-year yield rising to 291 almost. The Bloomberg US dollar index is dropping, and as Kailey showed earlier, the yen isn't gaining, so people aren't piling into those safe haven currencies. And Bitcoin is rising again, almost $2,000 to $30,524 after another incredible fall. What I find most interesting really today isn't Bitcoin or Terra, Luna, although going to zero is shocking, but Tether. Kailey and I got an email from the former CEO, the founder of Tether, or at least his FLAC, saying Tether isn't pegged to the dollar, it's backed by a dollar. They claim still that they have enough assets in cash and cash-like securities that there's always going to be $1 for every one Tether, even if it's worth 90 cents or $1.10, Kailey. So I thought that was really fascinating.
Yeah, and of course, that's something you and I will continue to explore on Bloomberg Crypto. I also am exploring the action in pre-market trading this morning, and there are a number of really big movers to the upside, including Affirm, which is that buy now, pay later company. It reported results after the bell yesterday, topped expectations, plus analysts say some of the management commentary around funding needs is actually really positive. So that stock is up about 31%. We also are seeing a big move for Robinhood. It's up about 20.5% at the moment. Sam Bankman-Fried, the billionaire founder of the FTX crypto exchange, disclosing a 7.6% stake in the company. So that's giving a nice healthy lift to that stock in early hours. And of course, part of the reason Robinhood has been down so much up until this point, down 77% since its IPO, is concern out there that the retail trading boom may be fading. That meme stock mania is a thing no more. And yet, once again, some of those meme stocks reared their head yesterday, including GameStop, which was up as much as 32% at one point intraday, ended the day about 10% higher, but it's up nearly another 6% in early hours this morning. And as Matt was talking about, that lift we're seeing in Bitcoin, the stabilization across cryptocurrencies, that's reading through to Coinbase, which is up about 11.6% before the bell, Anna.
I miss those days where another day, another crypto named after a dog. They were fun times. Let's talk about where we are on European stocks then. A couple of hours into the European trading day, of course, and we've got European stocks moving higher, up by 1.2%, really catching up with the gains that we saw later in the day on Wall Street yesterday, that turnaround in sentiment, partly a Fed conversation as well, the Fed pushing back against expectations of higher rates. That's working here on the European equity markets. The euro is interesting right now. We saw the euro under pressure against the dollar, but also crucially against the yen, and this got a lot of attention from market macro watchers. That story of yesterday being unwound a little bit, and we see some euro strength here. The Italian 10-year yield I put in, I could have chosen other, certainly longer end of the European curve, where we're seeing buying of stocks, selling of bonds, and those yields going higher. And this is UCB. This is a Belgian healthcare business or a pharmaceuticals company, and one of the products that they were trying to get approval for in the United States, that approval looks a little longer coming than had been anticipated. So, Kailey, that's playing out badly for that particular stock.
All right, so that's what's happening at the micro level. Let's talk more about what we've seen at the macro level and the bleeding within equities that looks like it may be pausing, at least for today. Joining us now is Dan Boardman-Weston, Chief Executive and Chief Investment Officer at BRI Wealth Management. Dan, Michael Hartnett over at Bank of America put out a note this morning saying when you look at the outflows we have seen across asset classes, but in particular equities and technology stocks, he says the definition of true capitulation is investors selling what they love. Was that capitulation? Have we now seen it? Is it over?
I don't think we have seen capitulation just yet. I mean, this week has been pretty brutal, and investor sentiment, especially in the technology area of the market, is shot to pieces. But this does not feel like capitulation just yet. I think we're going to have a tricky few weeks and months ahead of us, and I think we're still a bit of the way off from capitulation.
Okay. Can I ask you about the Treasury markets, or indeed bond markets more broadly, Dan? I mean, we're seeing yields rise today, but we had got a sense that growth fears were back in the market or were in the market this week, and maybe that was something that was capping Treasury yields. Others suggest, no, that's not what's capping Treasury yields. We just priced in all of that Fed tightening, and now we're kind of coming towards the end of that. We've reached peak Fed hawkishness. What do you think is happening in bond markets at this point?
I think the narrative in bond markets and what bond markets have been concerned about has been slowly shifting over the last couple of weeks to a month. And actually, markets are getting more fearful of a recession rather than the inflationary issues that we've been facing for the last 6 to 9 months. And so I think what you're seeing is a greater chance that we are heading to a softish or a hardish landing, whatever Powell wants to describe it as. And I think investors are looking for protection in the form of government bonds, in the realization that actually inflation will start to come down naturally. But if we are heading into a weaker period of economic growth, that will naturally bring inflation down as demand subsides.
Yeah, and Dan, who gets there first, I wonder, in terms of that weaker growth picture? If you had to pick one of the Western central banks and said they're going to be the first to cut rates, so after we finish this hiking cycle, see how long it lasts, where would you say we're going to see rates being cut first?
I think it's tricky. I mean, the Bank of England has taken a slightly different stance to other central banks and have been more forthright in predicting where they think inflation will get to north of 10% in the UK by the end of this year, and also specifically mentioning the chances of a recession. And so I think it's probably the Bank of England that will be first to start cutting rates at some point late in 2022 or 2023.
In terms of the inflation outlook, I note that in Britain, right, Johnson and Sunak are getting a lot of blame for not doing enough. Here in the U.S., Jerome Powell and President Biden are getting the brunt of the blame. But it's really a global problem, right? How do you see it playing out? Did we see a peak this last month?
I think we were meant to see a peak if a lot of what has happened over the last couple of months hadn't happened in terms of the war with Ukraine and China going into lockdown. But I think, as the Bank of England have said, inflation in the UK is already high, and it is going to go higher. It's going to go north of 10% at the end of this year. So I don't think we have seen a peak in inflation yet. I think we've maybe seen a slight moderation in terms of the year-on-year change. But I think the path at the moment still is upwards, unfortunately. And it will make it very tricky for central banks to be tightening so late and tightening at a point where economic growth is materially slowing. Into a recession, right? If you're closer to Russia, are your chances of a recession higher? Is it higher on the continent than it is in the UK, higher in the UK than it is in the US? I think it's higher on the continent. I think, they're a lot more reliant on Russian energy supply than we are in the UK or clearly in the US. And actually inflation rates in the Eurozone, broadly speaking, are running at a higher level. But again, you've got this interesting stance that the ECB is, behind the curve, even compared to the Bank of England or the Fed. And so, again, the Eurozone is probably, and countries further to the east in the Eurozone, are going to be under a lot of economic pressure just as the ECB starts to tighten in July.
Dan, can I finally just ask you on the action we have seen in cryptocurrencies over the last week, and whether or not that is a leading indicator of what sentiment is likely to look like going forward, or whether it was just a result of broader risk-off sentiment? How do you view it?
Yeah, I think sentiment across pretty much all asset classes this year has been poor, and a lot of the investor sentiment readings are, historically very, very low levels. But I think what you're seeing in the crypto space is that commonly assumed principles to do with stable coins are starting to be questioned by investors, whether that's Terra or even the sell-off in Tether that we saw the other day. And I think that's going to get worse. I mean, I find it very interesting with Tether why they don't disclose the collateral that they have. If they've got
agreed. Fascinating.
Dan, thanks so much. Yeah, a lot of people want to know the answer to that.
Why
Dan
won't they be audited?
Chief Executive, they'll just come out and say exactly what it is they hold. Really interesting conversation. Thank you very much to Dan for joining us, BRI Wealth Management. Now, coming up, the panic in crypto taking a breather, but for how long? We'll pick up on that conversation. We're just starting there with Dan, get more detail on the latest in crypto. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Reid Hoffman of Greylock Partners. That's at 5 p.m. in New York, 10 p.m. in London. This is Bloomberg.
I don't think it's a Lehman moment. Obviously not the prettiest of episodes, but we get one to two of those per year. You remember last year we had the China ban. The previous year, due to COVID, we had up to 50% declines. So this time, I think what is different is that you have a limited number of sellers.
They present the same kind of risks that we have known for centuries in connection with bank runs.
That was Nexo co-founder Anthony Trenchev, of course, Treasury Secretary Janet Yellen after that, talking about the volatility that we're seeing across the crypto space. The panic subsiding today to some extent, despite the blockchain behind Terra USD being halted at least twice. I'm not sure, 2 or 3 times. Lionel Laurent, a Bloomberg opinion columnist, joins us from Paris to talk about how important this is. And Lionel, that's been a debate in this office. How key is this to the broader market? Does it really matter or not? What's your take?
I think it does matter. I think obviously the bullish types are going to say that we've seen this before, which in itself is a weird admission of the kind of frequency of a 50% drawdown. But I think there are feedback loops with the wider economy. I think the link to risky tech stocks is obvious. And it's evidence that in a sort of stagflationary, even recessionary environment, crypto suffers more than most because it is a mix of unregulated finance and dodgy tech. I mean, is this tech really ready for prime time if nothing works as it should when prices start to fall? I'm including stable coins in that, as we've seen. I'm including so-called inflation hedges in that, and exchanges. I mean, we've seen exchanges do a lot of suspensions and delist coins they were listing and promoting just a few weeks and months ago. So I think things will be different for a while, even if it's hard to say today, as you say, with the stabilization, that this is a fatal moment yet.
But will we see a spread, a contagion? Matt Levine was writing yesterday that if you ask somebody before 2008, how much does it matter if super senior synthetic risk obligations compiled of subprime mortgages collapse? Like, you would never have thought that's going to affect the broader market, right? Especially if you were just a retail investor. Does this potentially cause more problems than just for people who owned Luna at 119?
Well, yeah, I mean, we don't want this to become a Lehman moment, right? That's the point. That's why we want regulation in place, and that's why I think regulators have an opportunity to at least crack the whip a bit harder. I mean, look at Tether. I remember when Tether and Bitfinex were hit with financial penalties for misinformation.
Yeah.
I think they were even banned in New York. Where are these settlements going? Who's really being stopped from trading. There are genuine frauds and Ponzi schemes in crypto. I'm not sure they've been adequately punished.
Mm-hmm.
And I think there is just a real pressure here to stop activity that is really happening, a lot of it happening offshore, to get a grip on it, because retail has a lot of access to this stuff and it is dangerous.
Well, Lionel, speaking of activity being stopped, I want to bring some breaking news to our audience. Elon Musk saying that the Twitter deal is temporarily on hold pending details, saying in a tweet that it's pending details supporting the calculation that spam or fake accounts do indeed represent less than 5% of users on the platform. You are seeing an immediate reaction to Twitter stock in pre-market trading. It's now down about 10% in early hours, trading at $40 a share, so of course more than $14 below what Elon Musk's offer price of $54.20 a share was. Leo, I'm wondering if we could just get your reaction to that, to this saga we have seen playing out between Elon Musk and Twitter, and whether or not this deal actually is going to go through.
I mean, I think what we're seeing at the moment everywhere on the market in tech assets is this unraveling of the lockdown boom, which was driven by both retail traders who are trading a lot of these stocks and also as consumers glued to their screens. I don't think it's a surprise to see all sorts of meme stocks crushed by the combination of the post-COVID environment and inflation and war. I'm sure Elon Musk is not the only billionaire who's trying to profit from it, mop up and consolidate a lot of these companies. But as the market reaction shows, what their actual value is, what their worth is in a time like this, which is really being tested by inflation and at the same time potential recession, that's a real question mark.
And Lionel, it's Anna here in London. Really great to have you on at this moment, because you've actually written about these two stories in conjunction. You've been talking in the past about how Elon Musk's, Twitter, which he's trying to get hold of course, has actually been, in your words, a crypto swamp that you've said needs to drain, because it's been a place where people can, launch crypto scams, digital currency scams, and the like. What do you make of what we've heard so far about what Elon Musk would do to Twitter, and how much that would add or take away from public debate and public conversation on important matters?
Well, I think, as always, it's the question of whether Mr. Musk or whoever takes over Twitter is going to be a firefighter or an arsonist. I presume that if they've allowed scam accounts to flourish, it's because there is money and engagement and activity in that. I'm sure crypto Twitter provides a lot of engagement and activity, even if they claim to control and ban and regulate ads on the platform. So I think it's going to be a contradiction. It's going to be a dilemma. I'm glad to see in the UK that one of the regulators that's at least kind of alert is the advertising regulator when it comes to crypto ads. I think exchanges are a big part of the problem in terms of giving fuel for this fire, and I also think celebrities, influencers on social media also have questions to answer. It's a big problem.
All right, Lionel Laurent, Bloomberg opinion columnist, thank you so much for joining us with your thoughts and bearing with us as we react to this breaking news, which I do just want to recap now. Elon Musk saying on Twitter that his deal for Twitter is on hold pending details that he says details he is seeking regarding the amount of fake or spam accounts on the platform, which Twitter says is less than 5%, but he does indeed want confirmation that it represents less than 5% of users. We are seeing an immediate reaction to both Twitter and Tesla stock in pre-market trading. At the moment, Twitter is seeing its losses increasing, down about 18% right now before the bell to $36 or $37 a share. Remember, Elon Musk had offered $54.20 for this company. Meanwhile, Tesla is catching a bit of a bed. That stock is up the better part of 5% before the bell, as again, Elon Musk says the Twitter deal is on hold for now. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. We want to get back to that breaking news. The deal for Twitter from Elon Musk is on hold for now. That is according to the man himself, who says it's temporarily on hold pending details supporting the calculation that spam or fake accounts do indeed represent less than 5% of users. Twitter shares are taking 18% in early hours. Tesla is up by the better part of 5%. Let's get reaction now from Alex Webb, Bloomberg Quick Take reporter. Alex, is Elon Musk trying to back out of this?
I mean, maybe. It could also be Elon trolling again. It could be Elon being sarcastic and saying, sure, I'm going to cancel the deal because only 5% of accounts are spam bots, as though that makes any difference. There's no regulatory statement here. So, is it something which the SEC are going to look at? I would wager very heavily, if I was a betting man, that might be the case. But, it certainly doesn't look good, and you've seen the share reaction.
What would it be about the percentage of accounts that are spam or fake? What would it be about that would put Elon Musk off or convince him to stay with the Twitter deal? What is important about that detail, do we think, Alex?
Well, that's why part of me thinks that actually he's being sarcastic, right? Because it shouldn't necessarily make a big difference. There are two ways of looking at it. Maybe only 5% of accounts are spam or fake accounts, but also how much do they tweet? If they're responsible for 15% of tweets, it's a slightly different calculation. He could be saying, if we take him at his word and say that, yes, he is going to put the deal on hold because of this, that actually maybe there's not as big a differentiator as he'd thought. If he's going to come in and say, I'm going to get rid of spam accounts, and there aren't that many spam accounts to get rid of, then actually the upside for him is limited.
Right.
Exactly. I had initially read it like, oh, maybe Twitter's not as broken as I thought it was, so I don't have to come in and fix it. But now I'm thinking maybe he's saying, oh, maybe Twitter is more broken than I thought it was, so I don't have to buy it, like looking for an excuse to back out. He does have a breakup fee, right? If financing falls apart, he's going to have to pay $1 billion to Twitter just for this whole joke.
Exactly, and actually that was the one concession, meaningful concession at least, that the board managed to extract from him in its negotiations, this $1 billion breakup fee. And for Twitter, of course, $1 billion goes a lot further than it does for Facebook. That's a sort of rounding error when you look at Facebook's free cash flow. Twitter makes only sort of $3-4 billion a year in operating profit. So, that is something that, ironically, if they had that sort of money, it would help them crack down on their spam problem.
OK, Alex, thank you very much. Thanks for the hustle. Thanks for getting to set so quickly to take us through your thoughts on Twitter. A lot we don't know about this story, but what is clear is that the share prices of Twitter and of Tesla are responding to this. So we're seeing selling of the Twitter share price after Elon Musk says that the deal is on hold. He's looking for further details, wants more detail on the level of spam accounts. And you can see that the Tesla share price, linked as they are, that is moving higher pre-market. That's it for the early edition. Surveillance is ahead. They'll keep on top of this story. This is Bloomberg.